Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Drew Meredith from Wattle Partners, mate. How you going?
Good, yourself?
Pretty good. We're just talking about black eyes and getting heaps of sun in down here in Melbourne. We're going to talk about a few different things, but we thought we'd mix it up, talk about ETFs, talk about eSports, talk about, well, maybe even modern monetary theory. That will put people to sleep, but probably keep us awake. And then we'll just talk about 4 different ETFs. So, we thought we'd just pick 2 ETFs each and just see how we go. I guess the first thing for our listeners, like most people know what an ETF is. It's just a basket of things or investments inside it. So instead of buying an individual share, you can buy an ETF which might have 200 shares, it might have 3,000 shares inside it, and you buy units in that ETF, just like you would a normal share in your brokerage account, and you get exposure to something. So it's a really simple way to invest in a big collection of different investments. And I think most people know the basics of an ETF that listen to this show. But Drew, if you're looking as a financial planner, as someone who speaks to a lot of fund managers, if you're looking at an ETF, what are the things that you look for to determine what is a good ETF versus one that's probably not up to scratch?
I think it's probably less important now than it was, say, 5 or 10 years ago, when there were a lot of upstart ETF companies, like there are upstart fund managers as well. But back then, the biggest things were making sure they had enough scale. You don't want to buy an ETF and then it closes down. You don't lose money when it closes down. It's just you lose the investment that you the investment strategy that you had, or the exposure that you had.
So can you just explain that to me? Because so people ask me the question, what happens if my ETF closes? So what would happen?
Well, every ETF holds a portfolio of stocks, as you were saying before. So if it closes, the stocks behind that ETF are sold and you get your money back. Usually there's an option to sell it on market, or there'll be an administration process where they sell everything up, put it to cash, and you get a check like you would if you got a dividend from the same company.
So they would have to give you notice, wouldn't they, that they're going to close the ETF and give you the option to sell it now or just wait for the cash kind of thing?
Yeah, I think Vanguard and iShares did a few last year. And there's usually a notice with a warning. There's, once they've made the decision. And I think an interesting point there is that ETFs, because the fees are so low, usually, for the iShares S&P, it's 0.08%. Yeah. And for one that I'm looking at, it's 35 or 0.35%. So when your fee's that low, the company issuing that is obviously not making as much revenue. So you generally need more assets under management for that ETF to be break even. I think it's less of a problem these days. The market's kind of down to 5, I think it is, and all of them are reputable and of sufficient scale. I think it's iShares, ETF Securities, Beta Shares, VanEck, and Vanguard. Would you agree?
Yeah, there are a few around the periphery, but those are like the core ETFs that you would deal with. There are active ETFs too. I don't know if you can really class them as ETFs, because the way I think about ETFs is they're really just a wrapper. It's just a different way to get in and out of a managed fund. And so, there are things on the ASX now called active ETFs, which are effectively just managed funds. Yeah. And so you could probably class them as ETF issuers in one line, but not really. If you're just looking at the big players, you've named the 5 there. I think that conversation around, in the past, I would say to our members, make sure the ETF has $100 million in it. That's invested in it, because then if it has a really small fee base, it should at least cover its costs, maybe. And the reason for that was it's not the end of the world if you're in one of these ETFs that close down, like UBS closed down a heap recently. But the thing is, you don't want to be there because it interrupts compounding, right? Like if you can find an ETF you can just continue to hold, then you don't have to sell and incur capital gains tax, and just goes for the general admin of investing. So,
And if it was niche, you may not be able to find it again.
that's the thing, yeah. So you're better off, I thought, just waiting a little while. $100 million is just a line in the sand, by the way. Obviously it doesn't matter. Like I've spoken to some ETF issuers who have said, hey, Owen, you guys are penalizing us because we don't have $100 million. But I'm telling you that our ETF has 50 million and it's profitable for our business and we're happy to keep it for forever.
Yeah, the big point there is probably it doesn't need as much as an active manager would need to break even. And that's because they don't have to have a research house. They're tracking an index. So really their costs are in implementation. So people trading or paying the market makers. I think you've got another session on market makers.
That's probably the advanced session 2 or 201. That's a different class. Yeah, but I agree with you. It only really matters if you need to cover the costs. There are some ETF issuers, I won't name names, that have 1 or 2 really good ETFs, and by that I mean they're really big ETFs, and they make a bucket load of money for that company that provides the ETF. But then what they do is they use them to subsidize the loss leading ETFs that might be, a really low cost ETF, and they're never going to make money on it, but it's okay because they've got this other part. And like you say, it's all just algorithmic trading from ETF issuers perspective. Money goes in, market makers do their thing, units go out. It's really simple once it's done at scale. But that's some of the things that we can look at. You can look at like the size of the ETF, who issues the ETF. Then there's more important things around portfolio construction. What type of exposure you're getting. I always call it the expression of a trade. Like, let's say you want to, like, you've got your core bond, cash, gold, ETFs, all those things. You kind of know what you're getting. But let's say you want to invest in eSports, which is something that we'll talk about in just a minute. Let's say you want to invest in eSports. The way I think about that is, what's the best expression of that trade? So if you want to invest in esports and you think a few companies are going to dominate the industry, you'd be better off going buying shares. But if you want to just get a broad exposure to the industry, go and buy an ETF or invest in a managed fund and let them do the picking or what have you. So I always think about the best expression. And the way you can think about this is if you have 2 ETFs that do exactly the same thing, and one's half the fee load of the other one, just choose the one that's less. And that's how you get the best expression of whatever you're trying to get exposure to.
I kind of was negative on ETFs when they were first around, probably close to a decade ago, but it's that point that you're making that kind of attracted me. As an advisor, sometimes we need to be nimble and be able to buy something quickly, and ETFs are listed for our clients. If we make a decision, it's quicker than completing a managed fund application. But it also means if we can't get an exposure to, maybe it's not esports, maybe it's battery technology or something else, then we can, for us, it's about finding the best tool. And a fund manager might have 10% of their portfolio in that. But if you can get an ETF that gives you 100% exposure to a single theme and every part of that theme, not just the top end, it's incredibly powerful.
Yeah, so that's a good point, right? Like some of these ETFs, and this is the thing that you kind of butt up heads against when you're picking ETFs, and you feel like you're splitting hairs, but it's actually important. Some ETFs, like technology ETFs, are a good example. Like people say, I want exposure to technology. You're like, okay, what type of technology do you want exposure to? And some of them look like they're 100% technology, but then when you look into the holdings of the ETF or the structure of the index, they're actually 60% or 50% pure technology. And then there's this other stuff that's kind of like whatever is in the mix. And so you've got to think about that too, right? Like you've got to think, like you said, if you're an advisor and you're looking for something, you do have to split hairs occasionally, and you do have to be specific about what you want. But ETFs are generally a really good, pure way to do that. So Drew, there's going to be a few digressions here because I feel like the first ETF is a really good one because we get to talk about esports, and I'm happy just to provide a general overview of esports, and then maybe you can talk about the ETF specifically. But just so people are aware, eSports stands for electronic sports, and it's just basically video games. But now, thanks to the cloud, I could play a video game with you, and instead of watching us like this, talking about stocks or ETFs, you could watch us playing video games, and we could earn advertising revenue because you're watching us, or we could compete in a tournament and earn millions upon millions of dollars and play it in front of a stadium. There was a stadium in Poland I can't remember the numbers, but there's a stadium in Poland that physically, like people physically went there to watch a video game tournament, 175,000 people over a weekend or something.
So there were 23,000 at the Fortnite tournament in, I think it was New York last year before COVID, of course.
Yeah.
Yeah.
But the good thing
prize, $30 million prize for the total prize winnings, not just for the winner.
It's crazy.
So it's a real job.
Yeah, and this is the thing.
So stay on the couch.
I had a friend who has this for a story. I had a friend who was playing Call of Duty, which is a very popular combat game. And he was playing it online as part of his team. And they were like the best team, one of the best teams in Australia. And the award was Bitcoin. I don't know if I told you this story.
I haven't heard this one.
But the reward was Bitcoin. And this was like 2014, 2015. And he got something like 50 Bitcoin. At the time was worth bugger all. He had it on his hard drive and forgot about it. But then Bitcoin went to $10,000 or $20,000 and he lost the hard drive. So like people actually, this is an interesting way that people can get paid, but that has gone from getting paid Bitcoin to being a full scale, real legitimate industry that's earning, since 2017, I've got the numbers here, $655 million in annual revenue from the esports industry. Now it's tipped to be about 1.5 to 2 billion. That's the numbers I've got. So again, another example would be Twitch, which is where you can go online and watch people play sports. It's a website. It was bought by Amazon in 2014 for $1 billion. So it's crazy. It's the number 34 most popular website in the world.
People are moving off social media in some cases, and they go in and play a game, but also talk to friends and colleagues at the same time. Or talk while they're watching other people play. So it's kind of this, rather than watching a game of footy, or it just completely turned mainstream.
That's it. Like there are not most, but many young people these days, let's say younger people that are at school or even university students or whatever, you don't have to be that old. They come home, instead of, getting on the phone back in the day with the cable and just talking to your friend for 2 hours and racking up a bill, or later in life, coming home and sitting on MSN Messenger or the old, original instant messaging services. Well, now it's changed to, let's play a video game together where we can explore the same world and hang out and chat at the same time. Because in terms of stimulation, it's a lot more stimulating than sitting there behind a keyboard with just multiple threads of conversation. So there's always something new. And this is the next, I guess, evolution of that interaction and engagement online. And so
there's somewhere saying it was bigger than, I think, movie theaters and music combined now, the sector had got to that point.
Yeah, wow. Okay, that wouldn't surprise me, because I've got some numbers here, Drew. 124 million people watched the Super Bowl. I think this was a couple of years ago. 58 million watched the eSports final for League of Legends. And that compared to 32 million who watched the NBA. So it's bigger than the NBA. And people don't know this about esports, but what makes it incredible is there's typically one league in traditional sports, like one leading league, like you have EPL in soccer, for example, or FIFA controls the soccer. But in esports, there are multiple leagues around the world with teams competing for tournaments. There's teams in esports that are named after professional sporting teams. And so, there's multiple leagues, there's multiple ways of companies profiting from this. Advertising, we already mentioned, prize pools for players, sponsorships for like Nike sponsoring the sports, which is crazy when you think about it. They have nothing to do with esports. They're just doing branding exercise. You can talk about in-app purchases. So that's a big one. People have heard of Fortnite. The ability to get the players, the fans who play the game to pay, a few cents every day or something like that is huge. It's enormous. And so as an investor, you're sitting back licking your lips, because you see that the average age of players is 18 to 34 for esports. Viewers might be a little bit older, say in their 30s. But then you look at traditional sports where the viewership is 50 plus, and you see all the different ways that esports can be monetized, both at the game level, game creation, but all the way down to individual players, sponsorships, advertising. It's incredible. So Drew, we know that we've set the scene. how does someone in Australia think about this opportunity?
Well, this is a brand new. I actually wrote an article on it this week, which I think you're going to link to. And I got an email out of nowhere that said VanEck was launching an eSports ETF. So there's an index already in the US called eSports Index, or ESPO. And as you were saying, it expands the entire universe, not just, I call them the neat companies. I'll talk about them in a sec, but everything that plugs into it. So that's the advertising, even the processing power. So as you go up in quality of gaming, we've got new Xbox and new PlayStation due out later this year. But something like NVIDIA with graphics chips becomes more and more important as the quality of games and the quality of competition goes up as well. And then even something like the NBN or Telstra probably plugs in. I don't think it's in this portfolio, but something like Telstra probably plugs in there too. You have to have great internet connection to be playing online constantly. So the core of it, in my article, I talk about the NEAT 4. So the one of the big issues is esports companies are only a tiny proportion of the NASDAQ or the S&P, maybe as much as 1.5–2%, if that. So companies like Nintendo, EA Sports, Activision Blizzard, which owns Call of Duty, and Tencent, which is Fortnite, are kind of the core of this esports portfolio. And that's the e-gaming core, and it does hold NVIDIA and AMD, which is another microchip or a graphics chip producer.
Did you make up the NEAT?
I made it up. Yeah. We all love acronyms. I'm pretty sure someone else made it up somewhere.
Yeah, it's going to catch on, mate. NEAT. There you are, people. NEAT. That's how you invest. I like it. And,
I should have done that as a stock code, not ESPO.
And it's sponsored by Drew, of course. And so I've got some numbers here. The index has 25 companies in total, and it's very concentrated. Top 10 holding 60% of the portfolio. But the catch is that any of the companies in this index must have at least 50% of their revenue from video games or esports.
Yeah,
makes sense. And that's kind of when you look at an ETF and a strategy, it's a pretty simple but I guess pure way to include or exclude companies from an index such as this. And it's been pretty spectacular. Like if we just look back, and this was just some numbers recently, so past performance is no guarantee of future performance and all that. A 1 year return of over 60% from the index. This is the index only, not the ETF. And a 5 year return of 37% per annum, which is just outrageous when you think about that.
I think a big driver is NVIDIA, which we've seen is on a massive run at the moment. People have moved on from their role in the kind of old traditional computers and their increasing role in esports as well as automation and AI.
Yeah, the GPU, which is the graphics processing unit, is much more powerful for this type of computing because it allows computers to process many thousands of different actions at the same time as opposed to a traditional CPU, which does a lot, but it does it typically one at a time with processing. And so NVIDIA's GPUs and to an extent some other competitors are the leading in this sector and really important. And I think video games have been a real coup for those guys because there was concern about going to mobile only sports, which I don't think is happening at the rate that people think it is. And effectively, what's interesting is that it's kind of saved NVIDIA, and NVIDIA's just gone, boom, just taken off with this. So really interesting thing. Management fee of 55 basis points or 0.55%. How would you use this ETF, Drew? Would you have it as a core holding or would you have it more as a tactical position, a smaller position?
Yeah, I see it as a tactical. So if you've got a diversified portfolio, you probably want exposure to the large companies or the mega caps like the Microsofts and the Amazons, or in Australia, the big companies like CSL. And you'd fit this in as not a satellite type at a smaller exposure, but with basically you're getting exposure to one of the fastest growing themes. And that is what I think is the most important. There's the numbers here. The sector's grown 12% per annum over the last 5 years. And if you think about an economy that's slowing, you want to find the themes that are growing faster than the global economy. And this is clearly one of them. But
Yeah.
as you've seen, if it's up 60% in a year with high returns comes more volatility as well.
Yep.
So if you think, if you're holding, you probably want it at half your large cap or your core exposure.
Yeah.
On a very simple rule.
Yeah, I agree. Like I said, very simple rule, but I tend to agree. It's one of those things where people can become enamored and they think, oh, this is the next big thing. I'm going to put 50% of my portfolio in it, and that would be, in my opinion, outrageous to put that amount of money in something like this. It's definitely something that you have as an adjunct to your main strategy, that more predictable strategy. So that's the eSports ETF, ESPO ETF. It listed on the ASX not too long ago. Interesting one. So if you have any thoughts on that, listeners, please, or viewers, please come back and let us know. The ETF that I'm going to talk about has been around for quite a bit longer. It recently had a bit of a change coming back to the Australian domicile. So just so people know what we mean by domicile, if you go onto the ETF issuer's website or read the PDS, it will have a line there that says domicile. What that means is where the ETF is registered for tax purposes. Most of them are in Australia, but some of them are overseas. And if they're overseas, you'll have to fill in additional tax forms. So that's the big headache there, if you can call it that. But most ETFs are domiciled in Australia. This ETF, which is the MOAT ETF, I'm not sure how familiar you are with it, Drew, is the one that I'm talking about. It's one that I hold.
Yep.
Do you know it?
Yes, I think we've had it in one of our models for a while as well. Can't forget that name.
Yeah,
Moat. Sounds like Morningstar.
Yeah, it does.
Or Buffett. Yeah. Buffett and Morningstar.
Buffett and Morningstar, if they came together and came up with an ETF. But no, so there's one now called the GOAT, which launched at the same time as the eSports ETF. But the MOAT ETF is, if you're familiar with the works of Warren Buffett or Pat Dorsey or any of these, I guess, kind of figureheads in investing and talking about circles of competence and businesses that are competitively advantaged. What happens with this ETF, and it's by VanEck, by the way, what happens is there's a heap of Morningstar analysts, particularly over in the US. They're going out and they're researching companies and they're deciding whether a business has a wide moat, a narrow moat, or no moat. And obviously a wide moat, just like a ring around a castle, is the best type of competitive advantage or protection a company can have. And they assign these ratings in addition to doing some of their valuations. And this moat kind of weights the two. Wide moat ETFs with a good valuation get a position in the portfolio. And so right now, it's typically it says it has about 40 positions, but because it's staggered, the portfolio is staggered, it rebalances every now and again. You can end up with a fair few more. So at the moment, there are 49 holdings. Some of the big names in there, pardon me, Salesforce.com shares, Caterpillar, which does the big trucks, Constellation Brands, Boeing, all of these big names you've probably heard of on a global scale. I like it because it's an ETF that combines human oversight with a pretty stringent quantitative approach. It's US focused, so you get exposure to shares that you probably wouldn't already have exposure to. Turnover's not too bad. So you don't get that tax issue, like you don't get massive headaches with that. And the management
growthier than I thought too.
Yeah, it is. Yeah. So when I think maybe this is a sign of the times, particularly in the US, Drew, when you think about, I guess the types of businesses that get assigned these wide moats, they're typically more and more these really sticky software businesses and big tech companies. And they obviously command pretty good valuations too. Like an analyst sees how fast they're growing, even though they're massive, and they give them, pretty generous valuations. So they tend to find their way in there. One thing that's probably surprised me, and this might be to do with your growthy comment, is how volatile it can be. I thought being wide and moat, it would be a lot less volatile on the downside. But it's still pretty volatile, to be honest, but happy to own it. But
I've always seen kind of Morningstar and Buffett as being that deep value, or looking, what do they call it, the cigar butts, looking for really deep discounted. I think it's kind of meeting in the middle. Now you've got a company like Boeing in there alongside one like Salesforce at the same time. So sometimes the issue with value is people don't can't see the value or can't see the moat that's emerging in a tech company because of its valuation.
Yeah.
But they seem to be kind of getting the right mix there of really old, old school, sometimes mining businesses and fast growing tech businesses. So
It's a good way to get exposure to both sides of that coin and combine them into one. I think still, even though this is a pretty straightforward ETF, my opinion is that it still kind of fits in that tactical bucket. It's got a track record now going back quite a few years. When I originally bought it, it didn't have that. But I still think it kind of fits into that bucket simply because it is a bit unique. It's got a pretty high fee load compared to some of the really low cost index funds. So good ETF, unique exposure, something most people don't have time to do in Australia is to go out and research these businesses. So it's a good ETF. I like it. And that's my number one.
excellent.
What do you got for number two? And this is where we could go. Just a disclaimer: we could go on a severe tangent with this ETF. So.
Oh, we're not going there. We were talking MMT beforehand. I looked at, so I was saying to Owen, I was quite bearish last week. This is what it's like in lockdown in Melbourne. And then reading and getting on top of everything on the weekend, I've turned quite bullish, variety of different reasons. But I have been taking a look at ESTX, which is ETF Securities issued Euro Stocks 50 tracker. So the 50 biggest companies listed in Europe. I found Europe and Asia tend to be underrepresented in most indexes. So the MSCI is always tilted towards 60% to the US. Most managed funds are in US companies, global companies, but mainly US. And Europe just has some of the best consumer companies in the world, some of the best healthcare companies in the world, and some of the best manufacturing companies. Is probably what they're known for. So it offers a really unique diversifier, and this could fit into a core position as well. For an example of some of the companies is Louis Vuitton, Moet, Hennessy. Everyone's probably bought one thing from one of those.
I don't know
the champagne, not the bags or the cognac. Siemens, so the German conglomerate is probably the best word for Siemens. AMSL, so it's another chip producer based out of, I think it's the Netherlands. And then L'Oreal, so the makeup company. They're just a couple of the big holdings in there. Have you had a look at this one? Or
Yeah, I was telling you off air that it's probably not one that I'm overly familiar with because I've always had such a bad experience with everything that's going on in Europe. I find it so hard to predict, put it frankly. Like I don't know who's in, who's out. But I had a look at this before we came on today, and it just seems very straightforward. I think it's the IEU ETF, the iShares Europe ETF. I could be wrong about that, but that's probably a broader exposure, whereas this one's more targeted, blue chip focused, and it comes at a reasonable price point too, unhedged. So you're going to get the full experience there, but
on multiple currencies as well.
In multiple currencies, so that makes it a little bit more unpredictable. But I mean, what currencies are predictable?
Actually, only two: the pound and the euro. There aren't that many.
Yeah. But we talk. Maybe we won't get into MMT too deeply, but the big issue that holds a lot of people back from investing in these types of ETFs are Europe-focused ETFs, and this is a very bread and butter kind of straightforward ETF. The reason that a lot of people don't is because of the uncertainty around the economy in Europe and how things play out. I know I'm in that camp. So, but you look at it and you think structurally it's a lot cheaper than North American markets. So is the opportunity there? Is it not? And you seem to have, since last week, I just imagine you in the house in lockdown, can't leave. You're just looking out the window. I don't know, just things going through your head. They're walking over the window, they're walking back again.
Little, dot points and pins everywhere and strings like a detective.
Yeah, but you've kind of thought, well, I'm guessing you've kind of thought this is like it seems to make a lot of sense right now to have this exposure, obviously.
Yeah, I see a recovery play. So it's underperformed. The US has outperformed everyone. Europe's probably in the same boat as Australia, where performance has been all right. We've recovered a little bit. But I've kind of seeing some things I wasn't expecting out of Europe. So they stuffed up the original, after the GFC when everyone, You know, that places like Australia could reduce interest rates, and the US could do quantitative easing. Europe kind of went down the austerity way, which is, you know, increase taxes, cut benefits, rather than, you know, print money, stimulate with fiscal policy, and take care of the debt later on. And I think that some of the recent announcements, there was something like $1.3 trillion stimulus that kicks in next year, half of which is structured as grants rather than more debt. And it kind of looks like they're finally bringing fiscal policy together as a region, where it used to be money. The issue, as we could go into MMT, I'll try not to. The issue with the EU has always been that monetary policy is under one currency, but fiscal policy has to be done at an individual country level, and every country has a different relationship with every other country. So if you can get fiscal policy working together, then you've got hope of the region growing and benefiting from it. I'm kind of seeing the beginnings of that, I think.
Well, that's something that, if that happens, then the world better watch out and investors should pay attention, because if it does come together, then that's wonderful. I mean, how hard would that be? I don't know. I think all economists tend to agree that it's in the very hard basket. Not saying it's impossible, but it's very hard.
Yeah.
Maybe if the world comes to senses with this idea around MMT and how we can stimulate with fiscal policy, and to kind of be the lever as opposed to interest rates, I think at least early indications are that it's going to be extremely positive for these regions.
Yeah.
And so in a portfolio then, Drew, given that kind of the disclaimer around kind of the uncertainty over there, how would you be positioning this in terms of weighting, or, you know, is there anything else you're looking for with this?
I'd be pretty comfortable with it as a core. If you look at those companies, it's probably one ETF where you could know every single company in there and what it does. There'd be very few you wouldn't. I think it would warrant a higher exposure than something like an eSports.
Totally.
And given the general overweighting to the US, it would definitely make sense. I also kind of see with what's going on between the US and China, Europe is a natural alternative, apart from how far away it is. It's a natural alternative for trade as well. So if the US keeps firing up the trade war, the EU have kind of stayed to the side. So you may get some of that benefit.
Yeah, it's true. Who knows, in 5 years we could be having the conversation of how stable is Europe.
Trump going for a third term.
Yeah. So yeah, that's interesting. Yeah, I think so too. Like if you're looking for exposure to Europe, I think this, and the businesses that we know are great businesses, I don't see why. I can't find many negatives to this, and having it as I would probably tilt it slightly smaller than in the core, but still tilt it slightly smaller than one of these other core, like Australian shares or, you know, global shares style ETFs. But yeah, really interesting ETF. I didn't know much about it, and now I do. So thanks for sharing. And MMT, by the way, we'll make that a topic for next time, once you've done a bit more reading, and maybe once we're out of isolation. The final one that I'm just going to pitch is the Vanguard Diversified High Growth ETF. So for those who don't know what a diversified ETF is, we know that an ETF is a basket of shares or bonds or whatever is inside it. Well, this is a basket of baskets. So you have ETFs inside, typically ETFs, but there can be managed funds, inside the ETF. So you buy one ETF and that has multiple ETFs, which then invest in different things. The powerful thing about this is that you can effectively just choose your risk profile and invest in that one. And so the Vanguard Diversified High Growth is kind of everything in one bucket or one basket. And I can't remember if Beta Shares was first with this or Vanguard. I think Vanguard was first with this style of ETF. But instead of having 4 different ETFs that are very vanilla ETFs, or 5 very vanilla ETFs, and what do I mean by vanilla? I mean like index fund ETFs. You can just buy one, and then you can build your core around that, and then build your tactical exposures around that. There are some nuances. So I don't know, I'm guessing you know this, Drew, but some of the diversified ETFs, as far as I'm aware, have, and this comes back to that tax conversation early on, some of the diversified ETFs have non-Australian domiciled ETFs within them, which then creates issues with the W8 Ben form. So you do want to look at what's inside the ETF. But anyway, this ETF, from Vanguard. I think it's 90% growth assets, 10% non-growth. So like your bonds and that type of thing. Very simple, kind of just, it is what you get.
And it rebalances?
Yeah, rebalance. I think it rebalances annually.
Yeah.
I didn't get to the bottom of that. I think it rebalances annually.
Back to that 10/90 strategic asset allocation.
Yeah, I believe so. And the whole point of that is, someone from Vanguard's probably watching this thing, and you're wrong, buddy. But yeah. So as far as I'm aware, it's annually, and the basic idea is that with all index funds is, as you know, Drew, if you have the top 200 shares in an index fund, it's typically the number 195 to 200 that drop out of the index every year. And so and they're typically very small holdings. And what that does is it means that the turnover, the number of times shares are bought or sold in the portfolio, is very low. And that's good for tax reasons, because you don't have to then, report that as a capital gain or, income or whatever. So that's something that you would look at if you're looking at a diversified ETF. Not only kind of what are they invested in, which is essential, but then also what's the turnover? What are they looking at? What is the underlying fees? But this is just an ETF. It's a very simple one. We did a report on this, just kind of the diversified ETF industry as a whole, and kind of how it has the potential to become a very important, subsection of the ETF market if people kind of approach it. Like, if I'm honest, I would probably prefer to invest in one of these ETFs than use some of the more, I won't name names, but the fintech solutions out there that kind of do it for you, if you know what I mean. Yeah. You could just go with this ETF. If you have a brokerage account,
fintech might buy the 5 underlying ones from 5 different places, or which ones it goes into, whereas this one just goes into Vanguard underlying ETFs.
And that's the difference with this one, whereas as opposed to the beta shares one, which invests in ETFs provided by all different ETF issuers. I'm kind of the opinion, just go for the cheapest and most consistent one. Because as in, if you have 5 ETFs and you're deciding between this shares ETF, this shares ETF, and this shares ETF, go for the cheapest, most consistent one, most efficient one, and put that in the diversified ETF. So if they happen to be a majority from one ETF issuer, that's fine by me. But if they're just favoring their own ETFs, and that's not great. So there's plenty to choose from. This is just one example of the diversified ETF. You could look at all of the other Vanguard ones. Beta Shares has them now. So they're core ETFs, because you wouldn't really use one for a tactical exposure. I couldn't imagine what it would be tactical for.
But set and forget and reinvest distributions, and
that's it. Like, I think if my grandmother come to me and said, what can I put $10,000 in for the next 10 years? I'd say, well, probably something like this.
You sound like Warren Buffett.
Yeah, I do a bit. I mean, I invest actively, but this is kind of if you so you're a licensed financial advisor. If someone is not a licensed financial advisor and they're giving just ad hoc advice, I think saying the Vanguard diversified funds or whatever would be pretty.
You're not going to, you won't get any complaints.
Yeah, that's it. Yeah, you won't get ASIC chasing down, maybe. So this is just a very vanilla ETF. And you can bolt it in. Drew, just as an aside, I saw the video that you did. I got a sneak peek at this. You and Jamie spoke to Magellan yesterday.
Yep. Gerald Stack, the portfolio manager of I think it's a $15 billion infrastructure strategy. Bit of a fun interview, I think. Yeah, you asked some fun questions amongst some more serious questions. But I'm hoping that for the benefit of everyone, because currently, if everyone is watching this, they only go to Wattle Partners clients. Yeah. But I'm hoping for everyone's sake and time, maybe I can maybe listeners and viewers can get you guys to release some of them, because they're really engaging interviews. But do you have any more coming up? I got one a week for the rest of the year, or at least until the rest of lockdown, which I think is the end of November. So we got Nanook, which is you might have met Tom King before. I'm not sure if you've interviewed him. No. So we're talking to him next week, and the structure's deliberately casual, like one of your podcasts. So we meet probably 5 to 10 managers a week. We quiz them and undertake due diligence, and want to go. I mean, when you're investing with someone, you need to know the person as well as the strategy.
Yeah.
So a lot of it is about getting to know the person and then understanding the companies that are in that one line, same as an ETF. That one line represents 40 to 50 companies. So what's in there and why, and learning a bit more about that. So
yeah, cool. Yeah, that's the thing. You know, I always found it bizarre, to be honest, that a lot of investors would invest in fund managers in their funds and not even know who was running it. It's kind of like those that invest in companies. But it doesn't take a lot of effort to watch some interviews like that one, like our ones, with the fund manager to get a sense of if you think they're genuine, if you think their strategy makes sense. You don't need to be a finance expert to do that. You know, you can get a read of someone pretty quick. And I think the more we go on, the more those types of interviews are shown to people, the more people will become accustomed to understanding that fund managers are people, and you know the way they conduct themselves is really important. And it's not just, as you say, some sort of statement you get every year. And
we refuse to invest with anyone that we can't meet the person actually making the investment decisions. So we've had, in the last few months, we've had calls New York, France, not South Africa.
Do you speak French? Do you speak French?
Small, tiny part, not nowhere near enough. But you can meet. The beauty of what's going on is that all these people are now available from their own homes. You know, they're managing billions of dollars coming from their home to talk to you about why they invest the way they do. So it's quite insightful.
It's funny you mentioned that about active managers, fund managers, and meeting them before you invest your clients' money in them. I've got to say, I probably wouldn't, unless I have done a lot of my own research, I probably wouldn't invest with an active fund manager unless either I've done the vetting or I trust someone who has done it, because what can you go on? Oftentimes, in my experience anyway, the best fund managers are the ones that have more discretion over a portfolio.
Yeah.
So if those old invest by committee type investors, it's very hard. It's very difficult. And I think if you're investing in someone who is active because you want them to be active, you want to know how they're going to do that and what they believe. And I don't think I could bring myself to invest in an active fund manager without actually meeting them or having seen a lot of their interviews.
Yeah, definitely.
Yeah. Anyway, that's kind of an interesting thing to talk on the end there, but I'm hoping you can bring some of them to life for us. But if not, we'll just have to be back next week, mate, and bring some, hopefully a bit more optimism as we come to the end of stage 4 restrictions here in Victoria. If people want to get in contact with you, they can visit the Wattle Partners website. I'll put show notes in. They can email you directly.
Text me.
We'll put your number out. We'll just put it in the most popular part of our website and put it right there.
I'll be on NBA 2K if they want to meet me online as well.
Yeah.
True. My handle.
Yeah, you can. I'm typically about 4 a.m. on a weekday. Mate. Next week, if people have something that they want us to cover, we had a few people write in about eSports. So if you want us to cover something else, just let us know. Hopefully next week we can come back to it, mate. So thanks as always for joining me.
Thanks again.